Hey everyone, thanks for joining us today. I'm here today with Melanie Crisp, who runs our equities team. We were having a chat internally about some of the things she's seeing right now among producers as well as midstream companies. And we thought it was so interesting that we should record a video and share these insights with everyone else. So, Melanie, thanks for joining me today. And can you give us a quick overview of exactly what it is you're seeing in the market right now?
Hi, thanks, Eric. Yes. So in Q1 2025, we saw midstream companies reporting relatively strong earnings. But underneath the surface, there were some important signals from midstream, LNG, and upstream that emerged from an integrated landscape perspective. First, in the upstream production, particularly in Permian and Haynesville, we saw signs of slowing due to price weakness, capital discipline, and regional bottlenecks. Second, midstreamers like Energy Transfer, Kinder Morgan, and ONEOK discussed cost pressures from tariffs, steel prices, and labor shortages, all of which are inflating the budgets of major pipeline expansions and new projects. Meanwhile, LNG developers are moving full steam ahead with Golden Pass, Corpus Christi Stage 3, Plaquemines Phase 1, and others that are progressing towards 2026 and 2027 in-service dates. That means feed gas demand could increase by 10 to 15 BCF per day over the next couple of years. But here's the dilemma. If production grows slowly, or even in line with export demand, but midstream buildout lags, the U.S. market may not be able to physically deliver enough gas to liquefaction terminals, especially along the Gulf Coast. So, here's what the equities team will be watching for in Q2 2025 earnings. First, are producers revising production guidance downwards? Second, are midstreamers signaling project delays or capital constraints? And third, are LNG operators expressing any concern about feed gas procurements?
So it's super interesting because the market talks a lot about producers and capital discipline, but this idea of midstreamers is something that's kind of I guess maybe new in recent times. What risk does this pose for Henry Hub prices, and are risk to prices, is the risk skewed higher or lower?
Thanks. Great question, Eric. If infrastructure underbuilds or production underdelivers, Henry Hub prices are skewed to the upside. Think of it this way. If LNG demand grows, but the gas can't reach terminals due to upstream or midstream constraints, the remaining gas in the market becomes more valuable. That means tighter supply, more competition for gas, and higher Henry Hub pricing, possibly well north of $5 per MMBTU in peak months. Add in severe weather, regulatory drag, storage drawdowns, and the price risks tilt even further upwards. On the flip side, though, the only real path to lower prices would be if demand weakens or LNG projects get delayed.
And so right now, our production forecast has production growing, but not at the same rate as LNG exports. So is what you're saying that even if production does increase as fast as LNG exports, that the market won't be able to get this production to the liquefaction facilities?
Yes, that's potentially correct. It's one of the most under-discussed risks right now in the market. Matching supply and demand on paper doesn't potentially guarantee physical balance. If the midstream projects are delayed or underfunded or face permitting problems, the gas can't move from the Permian or Haynesville to the LNG terminals. That could lead to regional gluts and a discounted basis. Think about wall hog blowouts or flaring if volumes can't move. Meanwhile, Henry Hub and Gulf Coast prices may actually rise as LNG terminals are bidding for limited deliverable gas.
So if this becomes a real physical constraint for the market, when do you think this could start hitting? Are we talking balance of this year, 2026, 2027?
Probably late 2026 is when we could start to see constraint pressure build, but 2027 is the key stress test. That's when we'll have potentially 24 to 25 BCF per day of U.S. LNG export capacity online, with new trains at Plaquemines, Port Arthur, CP2, and even more ramping up. Unless production grows significantly and new midstream projects like Matterhorn, Whistler expansions, and Gulf Coast pipes stay on schedule, the system could hit limits. If either side of that equation falters, or if even both just move slowly, feed gas competition, pipeline scarcity, and price volatility could become a real story by early 2027. We're entering a period where LNG export demand is going vertical, but midstream and upstream capacity are both lagging. Henry Hub risks are skewed higher, and physical constraints may emerge by late 2026, with 2027 as an inflection point.
Great. This is all super interesting stuff. So, Melanie, thanks for joining us. Thanks for sharing your thoughts with the world and kind of the risks as you see them coming out. And we'll keep an eye out for your Equity Insights products coming out here in the next little bit to see how things materialize.